The rich get richer mainly because they earn in a different way than most people. While middle and lower income people depend mostly on salary or wages, wealthy people depend on ownership. They own businesses, shares in companies, real estate, land, patents, and financial assets. These assets don't just sit there. They produce income through profits, rent, dividends, and rising value. Once you cross a certain level of wealth, your money starts working harder than you ever could. One of the strongest forces behind growing wealth is compounding. When a wealthy person earns returns from investments, they don't usually spend all of it. They reinvest it. Over time, those returns generate even more returns. This snowball effect becomes extremely powerful over decades. Someone investing $10 million at 8% grows wealth far faster than someone investing $10,000 at the same rate, not because of intelligence, but because of scale and time. Access is another invisible advantage. Rich individuals have early access to opportunities like private equity, startups, venture capital, and large real estate deals, investments that are often closed to the public. They also have teams of experts, lawyers, tax advisors, wealth managers, and accountants whose full-time job is protecting and growing their money. These experts help them reduce risk, minimize taxes legally, and move capital efficiently across markets and countries. Cheap money makes the rich even richer. Because wealthy people already own valuable assets, banks are eager to lend them money at very low interest rates. They use this borrowed money to invest in assets that earn higher returns than the cost of borrowing. This is called leverage, and when used carefully, it multiplies wealth. Regular people often borrow for consumption. The rich borrow to buy income-producing assets. The financial system itself amplifies wealth. When central banks lower interest rates or inject money into the economy, asset prices rise. Stocks go up, real estate becomes more valuable, and business valuations increase. Since the rich already own most of these assets, they benefit first and the most. Wages rise slowly, but assets can surge quickly, widening the wealth gap without anyone cheating. Taxes also play a major role. In many countries, investment income is taxed more lightly than wages. Capital gains can be deferred, minimized, or offset, while salaries are taxed immediately. Wealthy individuals also use trusts, holding companies, and long-term strategies to preserve wealth across generations. Over time, this allows money to stay invested instead of being drained away. There's also the power of time and patience. Wealthy families think in decades, not months. They don't panic during market crashes, they buy more. When prices fall, they see opportunity, not fear. This long-term mindset allows them to accumulate assets at lower prices and benefit when markets recover. In simple, honest terms, the rich get richer because the system rewards ownership, patience, scale, and access. Money grows faster when you already have it, not because the rich are always smarter, but because wealth itself is a powerful tool. Understanding this isn't about envy, it's about clarity. Once you see how the engine works, you can decide how to use it in your own way.